I do want to bring in my markets guest, Kevin Mahn, Chief Investment Officer and President at Hennion and Walsh. Kevin, it's great to see you in studio.
It's great to be here, Kristen.
Thank you so much for joining.
My pleasure.
And I think many of our investors and viewers eager to hear from you in terms of your take on the market. What is it?
Yeah, I'd start by saying the Trump bump could only last for so long, and these types of short-term bouts of volatility, I would anticipate at least for the next few weeks, not only because of those rising geopolitical tensions between Russia and Ukraine, but we also have NVIDIA earnings later this week. We don't know what those earnings are necessarily going to tell us about the current state of the AI revolution. And then we hear from the Fed next month. Do they cut interest rate again? Do they pause? And what's their outlook going forward? That's a lot of uncertainty. But if I think out a little bit longer, Kristen, over the next 2 years, I'm optimistic that this bull market can run further.
Okay, and let's talk about that. The bull market turning 2 years old in October, just last month. You think we've got at least another 2 years in it. What is driving that thesis?
So we did the research back at Smart Trust, and what we found was that since 1946, that's a long time ago, there have been 12 bull markets. And the average length of those bull markets have been 5.3 years, with an average cumulative return of just under 178%. So this time could certainly be different. Past performance isn't indicative of future results, right? But if this holds true to those historical average, we might have at least another 2 years to run and perhaps another 100% in upside potential. What's going to help that? Those interest rate cuts that the Federal Reserve is forecasting, continued moderating levels of inflation, and perhaps some new policies that could encourage more economic growth coming from the new administration as well.
Amid the changes that we've seen in Washington, as you referenced, a red sweep, and of course what we see unfolding this morning on the geopolitical front. What does this mean for the aerospace and defense sector? I know a sector that you follow.
Yes, it's a great question and a great segue because I'm very optimistic about the outlook for aerospace and defense. It's certainly been on a tear this year as the Biden administration committed additional levels of funding towards the defense sector. I think that only accelerates during the Trump administration, Kristen, as our country needs to replenish, upgrade, and modernize our military warfare capabilities. What does that involve? Well, it may involve additional spending for the big defense contractors like Lockheed Martin and the F-35 fighter jet. But how about some of the ancillary benefactors of all that defense spending? A company like Howmet Aerospace, which actually makes the parts that helps the F-35 store. And then I think about modernizing drone technologies, satellite system from companies like Kratos Security. So the opportunities are out there and it's worthy of investors' consideration.
I do want to ask you how you as an investment professional are looking at some of the campaign promises from incoming President Donald Trump and what that might mean for the landscape.
Sure. I think the number one concern for most investors, even the Federal Reserve, is the imposition of tariffs. From my perspective, I think in a lot of cases, Trump's bark may be worse than his bite as it relates to tariffs. There might be more of a negotiating ploy. But if in fact he does impose tariffs, I'm not sure how inflationary said tariffs would be. We have to look at what countries, what products, what services. And tariffs today would be very different than tariffs 1, 2, 3 decades ago, as the American consumer now has more choices to turn to not have to pay those higher prices. So I'm not sure how inflationary those tariffs would be or how significant those tariffs would be imposed. So we'll have to wait and see on that front.
We have seen inflation, at least in the latest read last week on consumer prices, be a little bit sticky, and retail sales came in better than expected as well. Heading into this holiday season and amid the retail reports that we have gotten and will be getting this week, what do you see as the state of the consumer?
I'm concerned about the state of the consumer. What do we have? Nearly $1.2 trillion now in outstanding credit card debt. If in fact the consumer, which accounts for 70% of our economy, turns from paying and spending to servicing all that outstanding debt, the economy can and will only slow further. And I think that's what the Federal Reserve is concerned about as well. As in September, they updated their forecast for real GDP to just 2% for this year, and then staying at 2% all the way through the end of 2026. So the economy isn't necessarily receding or going into a recessionary environment, but it's also not growing. And that's why I think the path forward for lowest interest rates will hold, but perhaps be much slower and more gradual than some earlier anticipated.
The cold weather is finally starting to
Yes.
make its way, at least to the Northeast, Kevin. We
Might get some snow later this week.
Exactly, and felt it on the commute this morning as well. Heading into these winter months, what do you make of the energy sector in terms of how this could fare, even beyond that big picture too?
Yes, a lot of people thought with the incoming Trump administration, drill baby drill, it would be positive for oil and gasoline. I see energy through a whole different lens. I see it associated with the AI revolution, right? We know that these data centers require tremendous amounts of energy to run these massive AI algorithms. And our country has an antiquated electricity grid. So where are they going to turn? It's going to need to be a combination of multiple energy sources, whether it's electricity, natural gas, or now, as we're finding out, nuclear power. So look for those multi-utilities to provide the energy that these data centers need, and also for investment opportunities.
We are awaiting some boardroom remarks, Kevin, and we'll take our viewers there, of course, as GMO is set to ring the opening bell and talk about some of its ETFs here that trade at the stock exchange. But before we get to that, I also want to talk about healthcare, because this has been so in focus of late, of course, with the rise of GLP-1s, but also in the wake of a new administration coming in January that's made its own healthcare promises. What's on your radar in the healthcare space?
Yeah, I'm optimistic about the outlook for healthcare stocks. But when I say that, I don't necessarily mean large cap pharmaceutical stocks. In fact, I think they're going to have some headwinds that they're going to face, because if there's one thing that Republicans and Democrats agree upon, it's the need to lower drug prices, certain drug prices, and that's going to compress the profit margins of these large cap pharmaceutical companies. The same companies that have large revenue producing drugs coming off a patent and now being subject to generic pricing. So where are they going to turn to replace all that lost revenue potential? Well, I believe they're going to be acquisitive, and they're going to look to acquire the innovative healthcare solutions coming from small cap biotech companies, such as the GLP-1s for weight loss. But how about CRISPR? How about CAR T? How about antibody treatments, gene editing, gene splicing? There's tremendous things happening in our country with respect to healthcare innovations. Teaching the body how to fight off disease as opposed to injecting it with chemicals and toxins. So look for more M&A activity with small cap biotechs. That's where the puck is going. That's where the investment opportunities are.
How does the expectation of less regulation in Washington also change the deal landscape in terms of acquisitions that we might see over the course of the next few years that perhaps hadn't been happening?
Sure, I think it's going to be a pickup in the M&A landscape, not just for small cap biotech, but also look at financials. Some of those smaller cap regional banks that have been struggling. Look for more banking M&A activity, look for more M&A activity in the biotech space, and look across the corporate landscape. With less regulations, quicker approvals, you could see much more deal activity in the next 2 years at least.
So I want to drill in on the Fed a little bit.
Yes.
You and I know well, right, that what the Fed does obviously moves markets on a daily basis in real time, but also can set the tone for what is ahead as it meets every 6 weeks or so.
Sure.
Last I checked yesterday, in fact, investors or traders were actually pricing in about a 60% chance of another rate cut in December.
Yes.
I want to hear what you think is the right course for the Fed going forward, knowing that some of the data points have changed.
Sure. And unfortunately, I don't have a vote on the FOMC, so they don't really care about my opinion, but I'll share it with you anyway. So as it stands right now, as you correctly point out, Kristen, the market is expecting another 25 basis point cut next month. The Fed is also guiding us towards one more 25 basis point cut.
Kevin, now that we are officially open for trade, I want to revisit that Fed conversation that we were having and get your take on what the outlook might be.
Sure. Although the market and the Fed is guiding us towards a 25 basis point cut, I think Chair Powell gave a tell last week when he suggested that we're in no rush to cut interest rates. In fact, I wouldn't be surprised if they pause in December and perhaps adopt a much more gradual pace of rate reductions going forward, perhaps quarterly cuts through 2025 and 2026 until they get to their neutral rate of 2.9%.
And I also want to talk NVIDIA because artificial intelligence has been the buzzword for the past, 18 months or so at least. NVIDIA is going to report on Wednesday. It is one of the most valuable companies, will have an impact on the broader markets, obviously, that we cover here. What's your expectation?
I believe that by Wednesday afternoon, we're going to find out once again from NVIDIA that AI revolution is alive and well. Look, AI isn't a short road. It's going to be a very long road filled with many potholes. So investors need to be patient. Companies need to be patient with their CapEx spending. But NVIDIA is showing us that there is a path forward. Look, they're not stopping with Blackwell. Next year, they're unveiling their Ultra Blackwell chip. The following year, Rubin. And then in 2027, the Ultra Rubin chip. Now they're expanding into data centers. NVIDIA is providing a path forward, but there are many other companies that stand to benefit within the AI ecosystem.
And what are some of those companies? Are they specifically chip makers or other firms as well?
Yes, certainly chip makers such as Broadcom or even Taiwan Semiconductor, but look beyond that into the data centers, which are the nervous system of the overall AI ecosystem. Look at Digital Realty or even Prologis. And then I think about these data centers which really run hot, as we learned from NVIDIA with some of their overheating chips in certain servers. You need cooling solutions. They come from companies like Vertiv Holdings and Modine Manufacturing. So there's an abundance of opportunities within that AI ecosystem, and you need to look beyond NVIDIA, but don't ignore NVIDIA.
We've seen 90+% of the S&P 500 report so far, earnings this quarter. Most companies beating on the bottom line is typically the case, but what's your takeaway from the results that we have seen as we look to wind down this particular season?
So we got a blended earnings growth rate around 5.3%. That marks the 5th consecutive quarter of year-over-year earnings growth. That's good. But the disparity is very wide right now, and that earnings growth isn't just coming from all 11 sectors, but it's much more concentrated. We need that earnings growth to expand to allow the stock market rally to expand beyond those Mag 7. And the good news is, in the third quarter, those Mag 7 stocks, Kristen, only accounted for 9% of the total return of the S&P 500, whereas during the first half of the year, nearly 60%. So the rally is indeed expanding, but we need earnings to expand as well.
Are there certain sectors in particular that you see that are expanding, taking advantage of this moment?
Yeah, I would certainly look to utilities as a sector, communication services, information technology as a whole, but how about financials as well? Financials had a very difficult 2022 into early 23 because of the regional banking crisis, but they're bouncing back, so that creates opportunities as well. So look for continued expansion in those areas.
Kevin, you are a busy guy, I'm sure, meeting with all sorts of clients all over the country. I'm just curious, what else is on your radar?
What I'm really intrigued by right now is that investors are now coming back up for air again and looking for investment opportunities. Remember, Kristen, they were parked on the sidelines for the better part of the last 2 years in short-term CDs and short-term treasury yields, yielding 5.5%. And rightly so, perhaps, in some cases. But now they see the path forward is for lower interest rates. They also know the stock market's up over 50% over the last 2 years. So they missed out by staying on the sidelines. So I continue to remind them, don't try and time the market. Trying to time the market is an exercise in futility. Stay invested, give yourself the degree of diversification you need, and stay with your longer-term plan for both income and growth.
Kevin Mahn, he's the Chief Investment Officer and President at Hennion and Walsh. Kevin, thank you.
My pleasure, Kristen.